Before we get to the panel, we thank all the sponsors. I have to give one more thank you to Peter Braxton in the back with Envoy Capital. He was instrumental in getting a lot of the folks out here today. And he's also volunteered to be on a future panel explaining why family offices shouldn't be doing direct investing. So, so he has some opinions on the topic, so maybe we'll get some questions from him later. But as far as the panel, just to kick it off, maybe Eric, if you just want to just go down the line and give us a quick background on yourselves.
Yeah, sure. Do you want to do fun?
Yeah, at a high level, and then we can get a little more specific.
Okay, good. So my name's Eric Kieras with JZ Partners. We are a small cap direct investment firm based here in Chicago as well as in New York. A little bit different flavor maybe than some of the other folks up here on the panel. We kind of made the transition from family to a little bit more professional direct investing back in the late 70s with Jay Jordan, who was one of the first pioneers in this approach to investing. So we have about $1.1 billion in capital, permanent capital, closed-end fund. Gives us the flexibility of a family office, but some of the experience and resources of a more professional, long-term institutional investor. So a little bit of a hybrid. I've been with Jay 11 years now, investment banking before that, and look forward to speaking with you guys.
My name's Ian Smith, Hillcrest Holdings. We're basically a family office that focuses on direct investing. I've been at it about 2 years now. We still own our legacy business, which is in transportation. So that's probably at this point 90% of what Hillcrest is. But we are taking measured distributions out of the trucking business and deploying them into other operating businesses, primarily through direct investing.
John Martin with LDI Limited, which is Lacey Diversified Industries out of Indianapolis. I work for a fourth generation managed family office. My CEO's great-grandfather started a corrugated box manufacturing company at the turn of the 1900s and sold that business in the 80s and have been investing in lower middle market companies since then. We're permanent capital, diversified holdings, long-term view.
Hi, I'm Mike Schopin, Zenfinity Capital. It's based in Scottsdale, Arizona. I live here, I'm based here. Don't ask me why I'm actually still here, but my business partner slash boss, he makes me say the first, I say the latter, is a gentleman named Kevin Eastler, who is one of the co-founders of Sprouts Farmers Markets, the second largest natural grocery store chain in the country. In 2013, Kevin took the company public and then established Zenfinity Capital, where we do minority investments into that consumer, places they shop, food products and services they buy, and things in the supply chain that make products better for you.
Okay, great. Ian, you mentioned how 90% of the platform is really the legacy family business, and now you're starting to expand away from that, or diversify away from that, I should say. Why have you chosen to go direct rather than either outsource it or to invest with funds?
So we've held our family business, the trucking business, forever, so since 1955. So it's something being directly invested in, governing a private company is something we're comfortable with. But we realized we needed to diversify. So we looked at a lot of different options over several years. So doing things like funds, we found them to be quite expensive. We didn't like the opacity, the lack of control, and we consider ourselves very long-term investors. So the idea of 5 to 7 years and out didn't appeal to us. There's also the reason to why we're keeping the family together. So a lot of it didn't have to do with trying to generate the greatest returns, but trying a lot of the going direct rather than having we said, we could have a diversified portfolio of stocks and bonds, was much less appealing as a family vision than having a small portfolio of private companies where we could point at them and say, we're doing this in this community, we're doing this in this community. So it's a much greater shared vision for the family. So those are pretty much the main reasons.
Okay. John, I wanted to ask you, in looking at your career, you spent some time at a PE shop. Now you're with the family office. Can you talk a little bit about that, like why, maybe why you chose family office, what are the advantages, why not going back to a PE firm?
Well, the true reason is because they were crazy enough to hire me as opposed to why I chose them, but the advantages and what was really attractive. The folks that I worked with back in traditional private equity, I was with a lower middle market firm called Mason Wells out of Milwaukee, which was a wonderful group of investment professionals, close friends of mine. Enjoyed working for them, but the perverse nature of what we did, or the cliche was we always ended up watering the weeds and cutting the flowers. And so you would grow this wonderful business, sell at a nice profit, but then maybe redeploy through another fund and have to find another wonderful business in an industry that you don't know as much, with management teams that you don't know. And that always be, and then you spend all your time working on the businesses that you can't sell either because there's a problem with them and you're fixing them. So it was very attractive to work in an area where we could really cultivate, grow, see compounded returns, and build businesses over different horizons, and that unlocked a whole host of options that I never really had before in traditional private equity. That's the first point. The second point was the flexibility of how we can structure deals, the flexibility of what we can look at. Our mandate is to don't do anything stupid, don't lose money, and try to make money in an ethical, positive, fun way. And so our mandate has had a lot more opportunity to go do fun things, and that's been a really great opportunity for me.
Okay. Mike, you'd mentioned that you're focused on really kind of growth opportunity, earlier stage. Of all the areas you could have invested in, why does your business partner choose to go that path?
It's my boss.
Oh,
Tom said well that each family office, and this is the third one I've worked for, does this for a reason, for a goal. And that goal can change depending upon what the office is because, well, they have a family office for a reason. They're wealthy, they have choices. And so he likes the entrepreneurial journey. And he likes the founders and the founder mentality. He does not like getting up at 2:30 in the morning in panic sweat worried about a business anymore. He wants somebody else to do that. He really likes to share the stories and to share the journey and to help them along in building growth and success. And that's where he finds the most level of enjoyment out of this. And while there is a belief that clearly we can get economically important returns from the sector, part of that return is from that appreciation, from that enjoyment, much like you keeping the family together. That matters, and that plays into this. And anyone who's not thinking about that when establishing a direct investment office for a family isn't really thinking about the full complete return profile.
I'll just piggyback on that. The family that I work for thinks it's kind of funny to call themselves a family office. I mean, we use that as a term more than anything for marketing purposes, for deal flow. They're a family that likes to own businesses, and they like to be around that, and it satisfies their souls, and that plays a huge part in what we're trying to do.
Eric, you touched on earlier that you have a little different structure than some of the other people here on the table. Can you just dive a little deeper there and talk about any advantages or disadvantages of that structure?
So, yeah, we are a little bit unique. Under the Jordan banner, we have $8.5 billion in capital under management. We have traditional LP-based funds. We have other permanent capital funds. We have a European-based institutional investment group. And I think the advantage of that is perspective and experience. So one of the things that Jay Jordan talks about when he is building, to all you guys might know, we built this group because Jay likes to build companies. He likes to work with entrepreneurs. He likes to work with families to enhance legacy and build a company. When you're doing that, it's good to bring a certain perspective or value to whatever company you're investing in. And having those different funds, having 40 years of history, 500 different acquisitions that we've made, that perspective is a big advantage when working with families who are going through the same things that all families go through: succession, generational transfer, what happens to my legacy, my management team that helped me build this, how do I take care of them? So being able to see different deals across the globe, different sizes, different investor bases, that perspective is a big advantage for us. Now, it can also be a disadvantage in that it's confusing. It can be a confusing message when we're trying to sell a family approach, permanent capital, and we have a $3.2 billion LP-based fund, the Jordan Company in New York. People get confused by that message, right? Or what are you trying to do? Are you trying to flip me here? I just saw Jay in the news, and so I'm sure you guys have similar challenges with your families and the businesses they're involved in, whether it be the legacy business or not. But for us, that can create some certain unique challenges when we're talking with families and trying to differentiate with a little bit different approach from the traditional approach.
Okay. All right. Now we're just going to cover a few general topics. Maybe Ian, you can kick us off in terms of origination, especially it sounds like your platform's a little newer as far as doing direct deals outside of the core business. How did you guys think about it? Did you staff up? Is it a fairly small team? How do you approach the market? How do you find opportunities?
So I would say at this point we're still at this stage where we're dipping our toe in the water. We're basically two people, myself and my brother-in-law. So we're both family members. So if it doesn't work out, no professionals are out of the job. But basically we did a lot of networking. Went to events such as this, shook a lot of hands, get on as many panels as possible. Met investment bankers, fund managers, the occasional business owner. Did a fair amount of PR, especially in our neck of the woods in Iowa. Anything we could get articles written about us. We actually got a lot of fairly good deal flow just around our neighborhood, especially because if someone's thinking of wanting to do a deal, if they know somebody in the same city or the same part of Iowa who's doing this, then we're quite often their first call, just to even explore the idea, which has been a great benefit for us. And then we also tried, online platforms, Axial. There's a lot of the family business networks we've been fishing in.
So would you say a lot is coming from other family office type groups, or do you deal with a lot of intermediaries? I mean, do you want to grow your iBanker network, or where would you like to take the network from here, I guess?
We're not exactly sure, so we're still exploring that.
Okay.
I mean, we've been doing a lot of independent sponsors lately. We found some good deal flow from them. iBankers probably not so much. People around in Iowa, especially, we found some really good deals there.
Okay. Anybody else want to jump in?
Yeah, we're the type of businesses we look at anywhere from $2 to $15 million in EBITDA. We're generally buying from a family or an entrepreneur, closely held. Very rarely are we buying from, if ever, are we buying from true private equity. So we generate a lot of investment banking deal flow, just because you have to have some kind of, if you want to deploy capital, you have to have some kind of actionable items out there to be looking at. But we really look at the kind of the smaller boutiques, who are representing those kind of clients, and we're not looking at the blue chip firm deals as often, because that more frequently it's going to be private equity sale. It's going to be prettied up pretty well for our liking. But then at the same time, it's networks around Indianapolis, around Indiana, other families. We're trying to find the opportunities that maybe just aren't as widely shopped.
I think that's one of the benefits of kind of the family office approach or the permanent capital approach is if you have a long-term investment horizon, you should have a long-term deal sourcing horizon too. And the family office allows that. You're working with families, you're working with entrepreneurs. Ian's not going to like this stat I'm going to give him, but we did 3 new platforms last year, all with families that we've known for over 5 years. So, it takes time, but those are where the best deals come from, are those relationships. And having permanent capital, having a family approach, gives you the advantage to deal source like that, especially when you're buying from founders, not institutional investors.
And to add on, the advantage is that everybody's looking for differentiated edge in every investor, every investor. The challenge with funds is you have the cycle, so therefore you invest in the more traditional ways, verticals, sizes, things like that, you can create different edge, time horizon being the key one, when your asset base isn't going anywhere, when your return horizons are different. And so you can use that in your origination efforts to not necessarily get more deal flow, but get better deal flow.
Yeah.
Better for whatever your definition is.
Yeah, it's interesting. I think we're going to talk about some of the competitive advantages more later, but I'm just curious. That's great that you have this long time horizon. Is there any pressure from your family or your pools of capital to deploy capital? I mean,
From my what?
yeah, for your personal balance sheet. But so is there? I mean, are each of your families or firms comfortable being on the sidelines for a year or two?
Ours are, my family, the family I work for is totally comfortable with that. We recycle capital. I like to say we're opportunity cost investors more than traditional investors, and we don't sit on just we don't sit on like a checking account full of cash that's just waiting to be deployed. Most of them are sitting in the businesses, and we have kind of unique lending structures at all of our companies that allow us to move money up pretty quickly in a no hassle tax advantage way, so that way we can be actionable, but the money's not, it still has the opportunity to be put to work within the businesses at the same time if we want to. So we try to minimize kind of the opportunity cost of not being deployed, but the family is so, they're not interested in us making decisions that are motivated solely by like use it or lose it capital kind of decisions. And that creates kind of really risky outcomes, and they don't like that.
Yeah, and actually, John, maybe that kind of leads into our next question. Competitive advantage. We've talked about time horizon. Are there additional competitive advantages that you see by being a family office?
For us, that's quite frankly the big one. I mean, I'd say outside of that, our competitive advantage is not dissimilar from other firms. It's just unique to us, and what our experience is we're generalists, but we don't go after things that we don't understand or we don't have some kind of connection to, whether it's through the family or a board or a network. So our advantage in those situations is just our experience in the space. But the time and the approach is probably the biggest advantage that we bring in a pretty crowded universe. And there's a lot of capital looking for opportunities, and whatever the criteria is across this table, there's a lot of capital going after it.
Yeah, so along those lines, I mean, I wonder, their disadvantages. For instance, do PE firms use more leverage, therefore to pay higher multiples? Are you losing out on deals that, if you're at a different firm, you probably could win?
That's one of those yes, but it's because we're not. They are likely using more leverage than we are, almost always, because we like the ability for our companies to be able to funnel cash flow upstream, and so if you leverage something up to the hilt, that's not going to be part of the credit agreement. But the where we can become competitive is we're looking at returns over a much different time horizon, so that changes what our hurdle rate is. I mean, if we can get something that's maybe a lower return, but we're really comfortable with it, and we think that there's a lot lower level of risk with it, and we think we'll be able to get that over 10 to 15 years, I mean, that's still attractive for us to pay for. So the valuation exercise, it's not really an apple and orange lens that allows us to be there. But if someone, we're not really interested in going after the opportunities where you're bidding something up to a value that's crazy. So if we're in that scenario, that's probably going to be a bad outcome for us.
You mentioned the kind of the risk return concept. So I mean, over a 15-year horizon, what do you consider a low return? It's still interesting in the ballpark.
It really depends. I mean, we like to underwrite anything in the if it's not in the mid-teens to us, we're not going to be attracted to it at all. But that's probably situational too.
Okay, so you're still looking for double digits to even have a lower return profile. Okay. Anybody else? Any advantages, disadvantages that you've run into?
I think just the concept of being a long-term kind of hold is an interesting one, and it's evolved over the last, I don't know, 10 or 15 years. You know, a decade ago, you could have conversations with folks who, business owners, never heard of private equity before. You know, now that doesn't exist. Everyone knows private equity, everyone knows what deals are, everyone knows what their multiples are in their industries. There's no, it's all transparent. And so, you know, one of the things that we're actually getting pushback on a lot now is, you know, well, when am I going to get on? When's the second bite? You know, because they hear the second bite of the apple conversation. So now you're telling me your permanent capital, you can hold this forever. Well, how am I going to realize that, you know, what's going to happen to my 20% that I roll? You know, I don't want permanent capital. I want 5 years. I want that.
They kind of want the best of both usually.
Yeah.
They want you to have long term, but I do want my money.
Right. So it's introducing, you're hearing that more and more because I think they're getting pitched that more and more from investment bankers or their buddies who've done a deal. So it's a different dynamic that, you know, we have to kind of contend with on that end. Something to address.
Okay.
On the disadvantage side, again, family offices in general, you pick one, you now have one, right? Example. The challenge is, because they're run by families, they don't have traditional mandates, at least most of them, or they have flexible mandates, meaning their mandates can shift. And that becomes hard from a deal sourcing perspective if the mandates do shift over time, which they're all laughing because it happens a lot.
Oh, yeah.
And that's hard from both a partnership standpoint as well as a service provider standpoint, whether you're pitching companies as the entrepreneur, pitching companies as the investment banker. You know, is this someone who's going to get me to close? Where the likelihood in a Fund 7, you pick whatever sector you want, not getting to close is very low if they've done 30 or 40 with beforehand.
Maybe just a quick follow-up, Eric, on you're talking about the second bite of the apple. Have you guys found interesting ways to structure that, or is that just something you just have to deal with?
Yeah, I mean, for us, it's more something you have to deal with. It's more finding folks up front that you have aligned interest with.
Mm-hmm.
And, you know, it's not too dissimilar to any of our deal sourcing efforts. If the folks you're doing a deal with don't have the same expectations going in and don't have the same incentives long term, the deal's not going to work out, you know, regardless of what your advantages are. So it's more finding the folks who have the same time horizon as you, whatever that may be, and are committed to that kind of in together, out together concept.
Mike, you were talking earlier about what types of opportunities you're looking for. How do you leverage your boss's, you know, industry experience and network? I mean, is that when you're doing these growth investments, is that part of your pitch as far as what you bring to the table strategically, or how do you think about that?
So it's a good question. I think that what happens as an operator of businesses, obviously you get to hear all the noise, and you get to have all connections, the network connections along with it. And that comes a very wide network that then starts dissipating slowly over time, unless you keep feeding it. And so Kevin has run the supermarket since 2012. It's 7 years later. The 45 original employees that came with him to Sprouts, I would say 40 of them have retired on their stock options. So the network there has decreased over time, and he's not constantly tapping into it. But while that decreases, what doesn't is the constant understanding of how that consumer shops in this case, what they think about. And that's where I think the greatest advantage is that by bringing an opportunity that fits within that sort of paradigm, he's able to evaluate whether or not it actually does fit that consumer quickly, thus getting more comfort and decreasing the risk profile in his mind, which is a lot easier to do than if we were doing some healthcare service company that we would not know anything about. And so whether it's a geography, due to opening a few hundred stores over time, or an actual product or service, he's able to frame it with how he's interacted with that person as he built the business successful.
And I'm curious, have you been able to take that framework to any other, you know, tangential industries? I mean, are you still in a pretty narrow space, or have you broadened out?
So I think I would say why do it, right? If you're going to do that, then you have to go learn all the things that you got from the noise of doing this for 25 years. That's really hard to replicate. And so you just inherently become much more comfortable around what you have done and that which you've interacted with. And so long as those things are still true, you stick with what you want to know, in this case, what you enjoy. Again, part of the return profile.
Sure. Anybody else as far as kind of your core business relative to what you're looking for today?
Yeah, we've seen, one of the things that the family has leveraged over time is start with corrugated box manufacturer, commoditized product, which meant the way they sold was very relationship driven, very service responsiveness to be able to win new business. And the family has kind of used that skill set to go into situations where that may be true in a different industry, as long as we can validate that there's a good operation there, they have a good position, it's well run, but it maybe just needs kind of a kick from a demand generation side. We know how to actually create some value and grow in those kind of industries in a structured way, so we can populate that into some other areas. So that's gotten us into things like value-added distribution or transportational logistics, where there may be some kind of, at the surface, commodity-like service or product that, if you can pull the right levers, can grow.
Yeah, that actually kind of segues into the next topic. Eric might want to kick us off just as far as deal attributes. What types of opportunities are you looking for? We've talked about flexibility, but I guess kind of what's your sweet spot?
Yeah, we have kind of a simple playbook that's been developed over 4 decades, and it's the original buy and build strategy. We're looking for a good, profitable business with a good reputation, long history of cash flows, consistent management team. Back that team at 5 to 15 million of EBITDA and grow to 40 million of EBITDA, and do that with a heavy acquisition focus. So when we're going into a deal, we got to have a good management team, a good foundation to build on. The industry has to lend itself well to consolidation, benefits of consolidation, and the team has to want to consolidate. And if those things are true, the industry is really irrelevant to us. We're looking for those situations, the deal dynamics that kind of lead for us because they fit what we do really well. I think the only kind of unique thing that we're really honed in on today, because of where we are at in the cycle, is cash flow. We're looking for high cash flow businesses. Cash flow can get you out of a lot of jams, and it's hard to replicate cash flow. So we're looking for businesses that have a good, consistent track record of generating cash and converting it at a high level.
Okay. Anybody else as far as what you're looking for? Anything different? Is that pretty consistent with how you view the world?
I'm looking for the exact opposite.
Okay. Perfect.
I don't know what cash flow is. It's called equity. We're looking for high growth companies, right? High growth companies with good gross margins that can grow to be better, that can pick out a place in your market basket when you go shopping. That's what we're looking for. The benefit of consumer products is that if you find a really good beverage, there's 300,000 places in the United States that thing can sell on a daily basis. Right? That scale goes quickly. And so it becomes different. It's much, much more of a J curve, which means our companies are much more susceptible to economic downturns than Eric's, for example. So it's kind of the opposite of the spectrum.
Okay.
We look at a lot of the same characteristics that Eric's firm does. I think our businesses are smaller, so we care about, we want to hold it long term, we care about long-term fundamentals, we care about low major tech disruption that's got kind of existential risk to our businesses. Cash flow is huge. We're also just doing a massive assessment of management that we're bringing in, and it's never going to be at a business that's got $5 million in cash flow a year isn't going to have this perfect team that checks everything, but if it has enough of a leadership team that you can build on, and it's got the key, you're looking at motivations more than anything. You're looking at do they wake up every day wanting to win and make their business better. You're not having to push them, that type of stuff creates a lot of value in these smaller businesses. The cliche about a good management team and a mediocre business, it's true. They create value. You can find them. So we do a lot of team assessments more than anything.
Yeah, I would definitely second everything you had to say, except we probably don't, if it's, you know, if it's low growth in a smallish industry, it's still, if it's a cash cow, we can milk it for 15, 20, 30, 50 years, then we'd be happy with that as well.
Okay. Well, you know, a big trend in private equity in general is independent sponsors. So, you know, maybe Ian, if you could kick us off. You know, we've already talked about how you're kind of still building your network, but how do you view independent sponsors? Have you worked with some already, or you know, is that an area of interest for you?
So independent sponsors are very interesting to us, mostly because we're a very small team, and we like the idea of partnering with expertise, and the fact that we've done one deal with an independent sponsor in the cybersecurity industry, where upfront we actually negotiated a buy-sell. So we still want to have the potential of being in it for 50 years. We realized 3 to 7 years they're going to want out. So we basically have the first right of refusal to buy them out of all their fees and structure. It's definitely something we're going to look towards in the future. Whether or not we're going to make it one part of our main strategy, we're not sure, but it's definitely something we look for.
Okay. Anybody else work with independent sponsors?
I have.
Yeah.
It's deal sourcing.
Just another form of deal sourcing. Is that how you do it?
Yeah. I mean, we're used to be minority, so having an independent sponsors is you're a minority in a deal that they need majority. So, yeah.
Actually, the one we try to actually be the majority of them. So if they come in, we try to be the only equity, and we don't have to buy too much out at the end. Although our carry is expensive.
Yeah, we don't. We've got enough of an infrastructure that we don't like paying the second layer of fees for the work that we're kind of doing on our own, and I fit in the same way. We don't like. We would consider some kind of promote or carry if the group that was partnering with us was putting a bunch of their own capital in, but a lot of the ones we see they're not.
That's no fun if you're an independent sponsor.
But yeah, so it doesn't fit with the culture of LDI as much.
Well, I have additional questions, but I'll make sure we give the audience a chance. At this point, any questions from the audience? Any topics that you guys want to cover? Yeah, Adam.
I'm real curious from any of the gentlemen at the table. If you're looking at a potential, let's call it grand slam, you can't believe this deal is in front of you and you have an opportunity, but you're sensing a great amount of time required to make it around those bases and home, versus a deal that's a home run, not a grand slam, but a home run, and it's going to be simple. And the reason I'm asking is we have seen opportunities that we know exactly what we need to do to make it pay off big, but it's going to take a lot of work, and we don't want to do the work. How do you guys react to opportunities like that?
I'll take that opportunity they just talked about. I think,
And not necessarily a turnaround, just a lot of
just
work.
work.
Right.
And maybe we have the wrong view on this, but you know, in kind of the world today, we feel that to get the most value, you have to create value. It's a lot harder today to financial engineer a deal or walk into a sweetheart valuation or upside. And so we actually actively seek out those deals, and we do it for a couple of reasons. One, because we do think there's outsized value potential, and we have a longer term horizon. You know, Jay famously says often, you know, the biggest variable in IRR that people don't talk about is reinvestment risk. You know, you get your money back, you got 80% IRR in 2 years, great, what do you do with the money? It sits on the sideline for the next 5, do the IRR of right? So the time horizon, the amount of work, doesn't necessarily scare us. In fact, in some instances, it can be a benefit, because if I was sitting up here on a panel with three, mid-market LP-based funds who came across an opportunity like that, there's a good chance that all three would pass. So they say, I want a book on my desk that I can close in 90 days, and I can fit it in a box in my investment committee and go do it. So for us, I look at that as now I have competitive advantage, right? Now I can bring something to the table that's unique from what I'm going up against. So, all things equal, and it's still a good deal, and it's still someone we want to work with, I like those opportunities.
I'd echo most of what he had to say. I mean, the way we're structured now, once we get any sort of deal, I mean, we basically put down everything else and work on that one deal until it's solid. And then we'll think about moving on to another one.
We agree. I mean, we call it return on work. We think that there's a high level of return on work out there. And those are, we try to find those companies more than the ones that are prepackaged. In most anything, and we're pretty skeptical of a lot of things anyway, and it's anything that feels like a grand slam probably isn't anyway. So we like not messy from a turnaround standpoint, but just knowing that, hey, we're going to have to spend time on this.
So not to throw water on the fire, or however you describe this, but
It's good to have a contrarian.
right, I'll be contrarian just for fun. So every investment firm has three piles of capital. Right? You have human capital, you have working capital, you have the investment capital, balance sheet. They all cost something, right? And there's a balance and a trade-off between how you want to spend each of them to get a return overall to support the strategy. And so there's a wonderful case to be made for doing the hard deal, the hard work, whether you are able to do that by risk reducing or return enhancing or both. There's also a case for saying that's too hard and just skipping it and going to a smaller area and saying, I'm only going to focus on a smaller box, because you get a greater return on your human capital, sometimes your working capital too. The key with any of those things is consistency. If you're going to set up your organization to do the work, set up your organization, do the work, support people to do the work, and understand that they may utilize a ton of human capital, working capital, and fail at getting it closed. If you're not, then don't. But when you're in the middle, that's when people get in trouble, because you get the complaints from management, which can be true management or family. You spent a lot of time on that. Why didn't it go anywhere? You should have done something different. And that's really unfair.
Any other questions? Yeah.
There's been a lot of buzz about ESG, impact investing, and opportunity zones. Do you guys really care to actively seek out those kinds of opportunities? Or if you just happen to find one that's in a good space, you pat yourself on the back because you got two birds with one stone? Are you actively seeking social impact, ESG, opportunity zone investments?
So, no, but we do quote unquote require all of our portfolio companies do donate to local charities. Other than that, there are like one or two industries that some of our family members have very strong opinions on, and we won't go near those, but that's about it.
So it's more of a restricted list.
What's that?
More of a restricted list as opposed to we're trying to make a positive impact.
Other than donating, every company does donate locally.
So we have a natural bent towards those things. It kind of comes with the territory. I guess Kevin's been doing that since 1992, I guess, to some extent, giving better for you food. I will tell you that he gets a portion of personal return from things that make things in the world better. But we would never call it ESG, right? It's just kind of what he likes.
I'm curious, Eric, though, because you have some international money. My understanding is ESG is a much bigger issue over in Europe as opposed to the
Yes.
US. So you guys have not felt that pressure?
We haven't as much. Our European group, that is a big component of how they invest. And I'll say, some of the areas we've received maybe some pressure on our side is when we invest in businesses that maybe are counter to the trends that they're trying to maximize. So we have some questions to answer sometimes, but we don't have any specific mandates on our side.
Okay. All right. Any other questions? All right, I'll go back to the list for another question or two. I know we're getting a little tight on time. We've got a little bit of a late start, so go a few more minutes and wrap it up. How about post-close? John, you want to talk about, once you invest in a company, are you guys very hands-on? Are you deferring to management? How do you manage a company post-close?
The best line I've heard about it is from a gentleman with more kids than I have, but he always said our operating companies are like children. We treat them all differently. We're always involved from the standpoint of form a board, a lot of communication, especially early on, monthly business reviews, quarterly board meetings, but then just lots of on the phone, lots of visits, just to kind of make sure we can be as supportive as we can. In some instances, we'll be a lot more involved depending on what they need done. We have some resources that act as not like an operating partner, but more like internal consulting, human capital. So there's a business that has a lot of data that doesn't know necessarily what to do with it. We have a group of a couple folks who can do a lot with it, and then maybe help the business think about customer segmentation in a way they never have before. So we'll do that kind of hands-on, roll up our sleeves. We're never going to go in and say, okay, one of us is now the C whatever O, and we're not gonna lead day to day. It's going to be more kind of support from behind at a really detailed ground level, and then help from above at strategy level, sounding board.
Okay, maybe we just touch on when things don't work out. So maybe Eric, if you want to kick us off, if a deal does go sideways,
Yeah.
What's your process? Do you have a separate team for that? How does that work?
Yeah, no, we don't have a separate team. Our teams are kind of cradle to grave. And I think, there's really, two things that could probably answer every question we've talked about today, regardless of fund structure or family or whatever, is you have to know what makes you valuable, and then you have to align your interests with your partners, and they have to appreciate what makes you valuable. And so I think, we go into situations where we can bring perspective or resources to the table when things go south, if things go south. But to us, it's more about the partnership with the management team and spending a lot of time up front aligning your interests for the good and the bad. And that's how we get through, any kind of downturn that we need to. Obviously, we have the luxury of time having permanent capital, but if you don't have alignment of interest, if you don't have everyone rowing the boat in the same direction, it's very difficult to get out of those situations, and it's very time consuming to do so. So it's planning up front to align your interests and make sure people are incentivized the same way. That's really the preparation that helps you best of all.
Okay. Any other questions from the audience? All right. Well, we're a little past the hour, so I want to make sure we leave time for everybody to chat with the speakers. So with that, I think we'll wrap it up, and just want to thank the panel for participating.